Welcome, folks, to our discussion on crypto earnings abroad and the tax rules every digital nomad really needs to know in 2025.
I'm really excited to dive in here. What's the overarching issue that digital nomads face when it comes to crypto taxes?
Well, the biggest challenge is tax residency. Digital nomads are constantly on the move, and that creates confusion, like determining which country actually gets to tax their crypto earnings.
Right? And that confusion can lead to situations like, double taxation, where you end up getting taxed twice for the same income.
Exactly. And you see, this double taxation issue, it's really compounded by the fact that tax laws differ so much between jurisdictions. On one side, you've got income tax, capital gains tax, even self-employment tax for crypto earnings, depending on where you're filing.
So if a digital nomad is earning crypto while moving between, say, the US and Portugal, they could end up dealing with both US and local tax rules.
Yes, that's right. And what's even more interesting is that many digital nomads, particularly Americans, are facing these dilemmas more than ever. Recent research even shows a huge jump in the number of digital nomads, with around 15 to 17 million Americans embracing this lifestyle.
That's a huge shift. So while these nomads enjoy the freedom, they're really getting caught up in the complexities of international taxation.
Absolutely. And it's not just about where you live, but also about a concept called domicile. Domicile is essentially your permanent anchor, which is a lot trickier to change than your residency.
And that means even if you're not physically staying long in one place, your domicile might still make you liable for taxes in your home country.
Exactly. And that interplay is often the crux of the problem. For instance, a country like the UK taxes domiciled individuals on their global crypto profits, no matter where the earnings come from.
But wait, isn't there also this idea that some countries have territorial tax systems where only locally earned income is taxed?
Yes, indeed. Exactly. In countries that operate a territorial tax system, like Singapore, digital nomads can, potentially avoid tax on foreign earnings. But here's the kicker. It depends on your residency status and meeting specific criteria.
So even if you're in a tax-friendly environment, you still have to be careful to not inadvertently become a tax resident there?
Right, and that brings us to another fundamental issue: accurate record keeping. Digital nomads must meticulously log every crypto transaction with dates, amounts, wallet addresses, everything really, to comply with tax reporting requirements.
Oh, right. Without that precision, it's almost like you're inviting audits or even penalties from tax authorities. And we all know how strict agencies like the IRS or HMRC can be about this stuff.
Correct. And speaking of audits, many digital nomads worry about disputes over tax residency because traditional rules don't really mesh well with a nomadic lifestyle. The criteria, like spending 183 days in a country, seem almost archaic when you're constantly on the move.
Yeah, it's like trying to fit a square peg into a round hole. These old rules just don't cut it for crypto transactions and remote work in today's globalized world.
Precisely. And let's not forget the issue of double taxation agreements, DTAs. These agreements exist to sort out which country gets the primary right to tax your income, thereby avoiding the double hit. But they're complicated, right?
Correct. They are indeed. DTAs specify details based on both residency and the source of the income. But even with a DTA, there's a lot of navigation required to ensure you're not overpaying.
Absolutely. And another layer of complexity is added by the kinds of taxes you might face. Think about it. Income tax on direct earnings, capital gains tax on trading profits, self-employment tax if you're hustling as a freelancer, and sometimes even VAT or GST on transactions when you pay with crypto.
That's a lot of tax types to juggle, especially when each jurisdiction has its own rates and thresholds. It's basically a labyrinth.
Oh, definitely a labyrinth. Take, for example, how the US handles it. If you hold on to your crypto for less than a year before selling, you're hit with a short-term capital gains tax, which is usually higher than for long-term holdings.
Yes, and some countries offer exemptions for long-term holdings, like Germany might, but then they have a different treatment for short-term gains.
Exactly. And that sort of strategy can be like a double-edged sword. On one hand, you can optimize your trades to reduce the tax burden, but on the other, you're always at risk of misinterpreting which rules apply.
Now, let me respectfully challenge something you mentioned. While optimizing trade timing sounds good in theory, it can sometimes encourage risky behavior if one is not careful with the market volatility of crypto. What do you think?
Well, that's a good point. It's like, while strategic trade timing can legally lower liabilities, in practice, crypto markets are extremely volatile. So yes, it's a balancing act between tax savings and financial risk.
Right, exactly. And then there's the idea of choosing a tax-friendly base. I've seen recommendations for places like the UAE, Portugal, or Malta, but I wonder, are these jurisdictions truly safe havens for everyone?
Not necessarily. While they do offer, lower tax liabilities or even exemptions on cryptos, you still have to meet residency or physical presence requirements, and sometimes even small changes in local policies can flip the script on you.
So the takeaway is, regardless of where you go, if you're a digital nomad, you need to be constantly vigilant about shifting tax laws both at home and abroad.
Exactly. And that's where working with a crypto tax specialist can be invaluable. These professionals help digital nomads navigate through intricate rules, ensuring that their record keeping is top-notch and that they're not inadvertently paying more than they should.
Absolutely, yeah. I guess that brings us to another point. How do international regulatory changes, like the EU's MiCA regulation, play into all this?
Well, MiCA is an effort to standardize crypto reporting among EU member states, which should help with transparency and reduce the ambiguities that come with different local laws. But it's still evolving, so digital nomads need to stay updated on these international standards.
For sure. So essentially, if someone is earning crypto abroad, it's not just about understanding the tax systems of one country, but also international frameworks and local regulations where they're staying temporarily.
Exactly, which means continual education and proactive planning are essential. It's really a dynamic environment where knowledge is power.
Right, knowledge is, yep. And speaking of planning, what kinds of techniques can digital nomads adopt to minimize their tax liability?
Well, there are several strategies. First, structuring your crypto income to, take advantage of tax brackets by possibly delaying trades can move gains into a lower bracket. Then there's spreading out income, or even realizing losses in a strategic way to offset gains.
Interesting. And does that include choosing a tax-friendly base, as we discussed earlier?
Absolutely. By selecting a jurisdiction with favorable crypto tax rules, like those offering low rates or exemptions, digital nomads can legally reduce the tax burden. But again, they have to be mindful of residency rules.
Right, it's all about making every move count. Also, I imagine having a clear digital trail of all your transactions is crucial, especially when you need to prove things during a tax audit.
Exactly. Detailed record keeping is like your insurance policy. Every transaction, including dates, amounts, and wallet addresses, needs to be logged meticulously. Tax authorities nowadays, from the IRS in the US to HMRC in the UK, require detailed reports to claim any foreign tax credits under DTAs.
Yes, it's really important. I guess one can't emphasize enough the importance of consulting with professionals here, because navigating between multiple tax regimes on top of fluctuating crypto values is a real headache.
You're spot on. This is a domain where operating without expert guidance can lead to hefty penalties, legal troubles, or even unintentional tax evasion. Experts can streamline this, assist with record keeping, and help with claiming eligible deductions and credits.
Definitely. To sum it up, the key is balancing the freedom of the digital nomad lifestyle with the structured discipline of tax compliance, especially regarding crypto earnings.
Exactly. It's all about being strategic, staying informed, and using the available tools like DTAs and professional guidance to protect yourself from double taxation and regulatory pitfalls. Thanks for this engaging conversation, and here's wishing all digital nomads smooth sailing, both financially and on their adventures
Right on,
around
yeah.
the globe.